big news today was the Reserve Bank of India's monetary policy. Now, everyone expected that there would be no rate cut. The rate cuts have already taken place and now it's time for implementation. But even so, all eyes and ears were glued to the messaging coming from the Reserve Bank of India's Governor, Shaktikanta Das. The reason for this was because still so far there has been no official number from the Reserve Bank of India of how much the Indian economy will contract this year because of the coronavirus pandemic. Now, we all know that the economy contracted by nearly 24% in Q1. So the numbers finally here, we will have a real GDP contraction of about 9.5% with a downward bias. That's what the governor said. But he has also struck a very optimistic note, saying that Indians have moved from an atmosphere of fear to one of confidence. A host of measures were also announced to add liquidity to the markets and within the system, to give a fillip to exports and also to give some relief to the real estate sector. Let's listen in to what Shaktikanta Das said today.
The MPC evaluated the domestic and global macroeconomic financial conditions and voted unanimously to leave the policy repo rate unchanged at 4%. The MPC also decided to continue with the accommodative stance of monetary policy as long as necessary, at least through the current financial year and into the next year, to revive growth on a durable basis and mitigate the impact of COVID-19 while ensuring that inflation remains within the target going forward. The marginal standing facility rate and the bank rate remain unchanged at 4.2%. The reverse repo rate stands unchanged at 3.35%. Let me take this opportunity to briefly review the state of the economy and its prospects. I have always dared to be an optimist, believing firmly in the ability of humankind to overcome the pandemic. In the months gone by, when COVID-19 raised in fury across the world, our hopefulness might have appeared impudent, like a flame flickering amidst a gathering storm. Today, there is a turn in the wind which suggests that it is not imprudent to dream of a brighter tomorrow, even in the bleakest of times.
So what does one make of what the RBI governor has said today? Two very clear messages coming in. One, that the economy is expected to contract by about minus 9.5% or contract by 9.5% this year with a downward bias. That means it can be even more. And on the other hand, a very optimistic note. I think one quotable quote from the governor today of the Reserve Bank of India was that the fear is over and a confidence has set in among Indians. Is that confidence warranted? And what really will these measures announced by the Apex Bank yield for the Indian economy? To speak on this, I am joined by Rathin Roy, Managing Director of ODI London, and someone who we love having on the show for his very frank views on where the Indian economy is headed. Good evening, Rathin. Great to have you on the show. Let me start with your take on some of the things that the Reserve Bank governor has said today in terms of the GDP projection. Finally, a number is out there, and also of the optimistic note that he has struck.
I'm extremely grateful for the Reserve Bank of India that 6 months into the pandemic, we finally have a GDP projection, and only one day after the World Bank. Negative 9.5%, you've seen my projections, in my view, continues to be a mild underestimate. But at least we have a projection. And that's important because now, going forward, we will need to know whether things that the Reserve Bank and the Government of India and others, the authorities do, are things that are intended to make sure that the final result is not worse than the projection, or are things that will actually enable the economy to decelerate more slowly than the projection entails. So If the government makes an announcement, does that mean that the projection will be an overestimate and we land at 8.5? Or the things that the government are doing is, things the government announces going forward are things that will actually enable us to land that projection. That's why this projection was very important. It's a pity it's come so late, but I guess I won't say better late than never. It would be nice if the finance ministry could also affirm its concurrence with this projection or otherwise, and then we could actually have an analytical argument going. Now, if this is the projection, then I don't understand what is there to be encouraged with in terms of psychology, etc. Does it mean that if Indians are feeling more confident, I have no means of judging, I'm sure the Reserve Bank governor has his sources sitting on the top of that building to judge the pulse of the Indian economy. It's a large organization. I don't have his sources. So I assume he's right, that Indians are feeling more confident, high frequency indicators are good. And the end result of that is going to be a negative 9.5% growth of the economy. Or does it mean that this projection has an upside? He didn't say that. But does it mean that? If it doesn't mean that, then actually it doesn't matter whether people are feeling good or bad. We're not psychiatrists, we're economists. And what we're interested in is that will translate into better economic results than we fear. And if the RBI's projection is minus 9.5, then high frequency indicators, people feeling good, Indians are confident. What does it mean? Does it mean that we will shrink less? We will be at minus 8, we will be at minus 7? Or does it mean that all this is why the RBI is saying minus 9.5? I don't know.
No, so let me talk a bit about those high frequency indicators, Mr. Roy, because we've been having a conversation about this for some time now on the program as well with a host of different people. I was talking to Mr. Pawan Goenka yesterday on the show, who was saying that he's astonished with the kind of demand coming in for tractors, for example. You're seeing reports that saying real estate is picking up. You're seeing a big company say that they're actually going to increase salaries this year. Corporate results are showing, positive signs. All these are there to see. So are you dismissive of all of these high frequency indicators? Are you saying they don't matter in the big picture?
No, they matter very much. I think they're very good signs. But the bottom line is we are still going to shrink by almost 10%, right? Or are we saying the RBI is overestimating the negative impact on growth? You see, the context of what you're saying is very important. Just common sense. So high frequency indicators are going up, people are buying more tractors, people's salaries are going up, the stock market is booming. Sounds to me like then we should be projecting positive growth, right? At the end of the year. Or are we saying, then why are we saying negative 9.5? And they're all saying that, now including the RBI, including the World Bank, including Rathin Roy, including Pranab Sen. We are saying 9.5 or worse, including Moody's. So all these good things are happening, meaning what? Are we all wrong? And is the Indian economy actually going to shrink much less? Or what? If the answer is we are not all wrong, then it is irrelevant whether these things are happening or not. If we are wrong, then it's very relevant, but no one's actually saying that, are they?
Some would argue that the shrinkage of close to 10% in the whole year is something which was to be expected because of the coronavirus pandemic. I mean, you can't take it out of the context of what has happened this year, and you're likely to see the global economy shrink. You're likely to see the GDP growth of most large economies, or pretty much every economy, shrink this year.
I agree. So then what is there to celebrate in these high frequency indicators?
So should we, I don't get it. So should we not look at these high frequency indicators? Does it not matter? Should we just wait for the doom to hit us and then move on from there? Give me the larger picture of what you're thinking.
But I think, I'm making a very simple common sense point. See, I'm not in the business of whether you feel happy about something. You can feel happy. I'm worried about where the Indian economy will be next March. And the RBI is saying we will shrink at negative 9.5. So if you're looking at these high frequency indicators and feeling happy, my question from that perspective is, are you saying that the RBI is overestimating the decline in the growth rate because of the high frequency indicators? If your answer is yes, then I will say to you many things. But no one has said that, including the RBI, right? So if you're saying that we are going to shrink at minus 9.5% and we are happy about the high frequency indicators, fine. I'm an economist, it doesn't make any difference to me then. Unless you are making one more call, which the governor has not made and nobody has made. that these unexpected pleasant surprises that people are getting, and I'm not in the business, as I said, of they're feeling happy in the evening that, oh, some good news has come. That's okay. I'm an economist. I have to worry about where the economy lands in March. And if the good things that are happening with high frequency indicators are not relevant to what is going to happen in March, then it is not interesting information for me. So if the high frequency indicators improving means our growth rate will still be negative 9.5, then I'm only happy that maybe you're saying, you're not said it, that if the high frequency indicators are not so good, then our growth rate would be negative 11.5. So until somebody makes that kind of analytical link between feeling happy about the high frequency indicators and what our growth shrinkage forecast is, they're not very interesting information to me, the high frequency indicators. That's all I'm saying. I'm not saying they're not good information to have or we should not take them seriously. But my negative 9.5 is pretty doomy and gloomy. And are the high frequency indicators making it less doomy and gloomy? Tell me if they are, if you think so. No one said that.
No, so there's no way to really know that could it have been worse, and is 9.5 a better figure than what the worst was? There's really no way to know. But then let's talk about what we do know, which is what the RBI intends to do and what it is doing in terms of easing liquidity, in terms of making housing loans more attractive to aid the real estate sector. All of these measures, do you think they are in the right direction?
Yes, the RBI cannot increase demand. The RBI can intervene to make the cost of capital cheaper and then hope that by the cost of capital going cheaper, there are price effects, essentially lower prices, which can be offered to revive demand. And the RBI is doing what it can do. Now the question then becomes, will these incentives generate lower prices, and then two, will those lower prices result in a pickup in demand? Now that depends essentially on what the nature of the structural change. So if you're in a situation where you make credit for real estate cheaper, but people are not going to buy real estate even if the EMI is lower than it was, simply because their ability to finance the EMI or their confidence in the ability to finance that EMI going forward has taken a hit because they are more insecure about holding to their jobs now, then the impact will be limited. But if people decide that they are feeling more secure, and that's probably why the governor said that people are feeling more secure, I have no means of knowing, then they will start investing or buying things that they weren't buying before. And obviously then making it cheaper for them to buy these things will accelerate that positive demand uptick, right? So the RBI cannot on its own ensure that the aggregate demand problem caused by a negative 9.5% growth shock is going to be alleviated. So quite rightly, they're using credit policy and they're using the regulatory framework to do what they can do. Whether it will have an impact or not depends on other things that happen in the economy, which have to pan out. So if a 9.5% unprecedented shrinkage in the Indian economy is consistent with increased consumer confidence and increased spending, then I'd be very interested to understand what the logic of that is. Because if your income aggregate in the country has shrunk by 10%, where will your demand come from? In a major way. So lowering prices can counteract that. So if my income has shrunk by 10% and prices fall by an equivalent amount, then maybe, just maybe, I will decide to buy what I would not have otherwise bought. So that limited extent, what the RBI done is good. But you must recognize that it is a very limited possible impact given the headline. Our incomes have shrunk on an average across the Indian economy by around 10%. Shrunk.
Is there a sense, Mr. Roy, that it could have been worse? And we will, of course, have to wait and see how this pans out globally, what happens to other economies or other comparable economies like India. But is it safe to say that it could be worse? We know minus 9.5% now, and from here on, hopefully things won't get worse.
Number one, we don't know minus 9.5% now. That is what the RBI has told us. Many others have given us much worse estimates.
And it's an estimate.
It's an estimate. And others have given us estimates in the double digits. But let us assume that the most optimistic estimate, which is minus 9.5, pans out. What's the point of worrying about whether things are worse? The real question to ask is when for the first time in at least 40 years, your income has shrunk, and for the first time since British rule, your income has shrunk by as much as 9.5–10%. How are you going to get back to where you were? And on that, my judgment remains what it was the last time I came. India will not be back at its 1920 levels of nominal GDP, real GDP, till fiscal year 22-23. It is only then that we can start talking about a growing economy again. You will obviously grow compared to the decline, but that is irrelevant. What is relevant is that India is supposed to be a growing economy year upon year. That has now stopped. So there's going to be a 3-year pause when we will shrink, and then we will come back to where we were, and then we will grow. That's depressing enough. So if somebody tells me
Inevitable?
that they can do
Is
things,
that inevitable?
not inevitable at all. And I don't, there's too little time to, sort of repeat this, but there are many things we could do on the fiscal front, on the monetary front, on many other fronts, not just institutional reforms, that would enable India to grow faster. But more importantly than that, I think when we come back to where we were in 1920, assume I'm right, in 22-23, we have to understand that the growth hit would not have been so bad if the Indian economy's output composition of demand was more broad-based than it is now. We are dependent on far too small a segment of our population, just 100–150 million, and the demand that they have for things like automobiles, fast-moving consumer goods, airline travel, etc. If 60% of the Indian economy had come from meeting the demand of the top 500 million, food, 400 rupee shirts, affordable housing, 15 lakh, ticket price, health, education, then we would have been more resilient to this shock. So going forward, I think the question is how do we make our economy more resilient so that we don't have to go through this nightmare that we are going through over the last 2 or 3 years again. That, I think, is where the focus of policy should be. And when I say making things better, I mean making things better not by shortening the V, but by making sure when we are out of the V, we are in a position where we are able to be more resilient to such shocks going forward, because there will be shocks going forward. So the resilience of our growth story is what will determine the success of our growth story. Not short-term measures to go back to the old normal. That's not going to happen. So the new normal must be a more resilient normal, a more broad-based normal in terms of the output composition of demand and supply. And then we will have what I would call a second and more resilient and more prosperous India growth story. It's our choice. We can make it, or we can choose to gently drift and receive further shocks like this, which will increase inequality, keep our growth base narrow, and that path leads you into a lower middle income trap. It's a decision point now, and we have to take that decision.
Absolutely. Well, let's hope the right decisions are made. Thank you so much, Rathin Roy, for joining us today. A pleasure as always to speak with you.